Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
You're watching State in the Economy on Bloomberg Quint, and we're in conversation with Hitendra, Head of Global Banking and Markets at HSBC, talking about the many small and large fires that are burning in the economy. Sir, absolute pleasure to have you here.
Nice to be here, Riga.
Okay, a bunch of things to talk about, but I'm going to start with your broad picture of how you think the economy is going to look in the second half of the year. Inflation is one good point. Fiscal is perhaps partly looking good, but we've got a number of other issues: currency, nervousness in the debt markets. How do you see the economy broadly right now?
So I think let's just break it into growth, inflation, financial markets, including exchange rate markets, etc. So I think starting from a growth perspective, best as I can judge based on my own sense, but also sense based on the customers that we talk to, corporate customers, large companies, mid-sized companies. Most companies tell me that they are having it quite good. Okay. And you can see that in many data points. Still fairly recently, you had automobile sales which were very strong. Now, I know September had a bit of a skew because of, let's see, whether it's demand related or whether it's regulatory issues which came in the way. But FMCG companies that sell to the rural sector, companies that sell to companies that finance the end buyer, if you look at their growth rates, if you look at credit card situations, all metrics would seem to suggest that businesses that are selling to end consumers and businesses that are benefiting from some of the infra spend that government is doing, and it's doing quite significantly in the last 2-3 years or so. I think both segments appear to be doing quite well. I think the missing piece has been capex, private sector capex in particular, but that's from a base perspective, it was very close to minimal last year. It'll be close to minimal this year.
Sure.
So on growth, I think while a lot of people thought the above 8% growth might be a one-off, might be related to the base or whatever, and I sort of won't get into the details of the GDP calculation, but per se, I would think the economy is doing quite well.
Okay.
From a consumption demand and investment demand linked to government spending. I think coming to inflation, the good part is while it's consumption demand, while it's infrastructure related spend as well, so far the growth has been non-inflationary. I mean, if you look back all of 2017, 9 months of 2018, the 21 odd months, my guess is the inflation rate on average has been at or very close to the RBI's middle of that band of 4 or so. I mean, that's quite tremendous. I think sometimes we sort of are not patting ourselves on the back a little bit. I mean, I don't know why we should pat ourselves on the back, but to the extent that as an economy or as a people or as a society, we seem to have had such a long period of relatively modest rates of inflation. I think 4 years back or 5 years back, when the Reserve Bank of India and the MPC and the government's mandate to RBI was put in, a lot of people thought that this is just not going to happen ever. I think we are setting ourselves up to fail, but we haven't failed. So that's there. Now again, on inflation, I would say a year back, if I had asked you, oil is going to be at $80 a barrel, rupee is going to be above 70. Now project inflation for me for September, okay, or for the quarter ended September. I suspect almost everyone would have projected at least 200 to 300 basis points higher than what it has actually come.
Yeah.
Now, I keep hearing people say, oh, it's not come as yet, it'll come in the next quarter or it'll come I mean, one day obviously it'll come. The fact is imported goods are getting more expensive through the currency channel. Oil directly and oil as an input into goods has become more expensive. But clearly something has happened to the food economy.
Yeah.
I think we are too much in the midst of it and it's too little researched. But something has happened to the food economy. Why? Therefore, bulk of the items, the potato, the tomato, the onion, the pulses, the sugar, a lot of other things are seemingly inflating at between 0% to 3% now for a long, long time, and which is obviously responsible for overall inflation being where it is. I think going forward next 12 months, if inflation is 4.5% to 5%, I mean,
then rates are steady as well.
Yeah, so I think more or less your rates are prepared for that. Market rates are definitely prepared for much worse. So I think that's on the inflation side. So I'm slightly sanguine both on growth and on inflation.
Okay.
I think coming to the other issue, which is grabbing significant amount of headlines, currency movement. I think obviously the extent of the depreciation has caught a lot of people off. That said, at least I haven't felt this time around the kind of panic or the panic calls that someone like, we receive, which we received in 2013 and in 2008. This time around, it appears to be that at least the amount of unhedged foreign currency exposures, which is really what triggers panic, and then sort of, the demand comes in just when you don't want the demand. At least we think it's been much, much better managed. Therefore, the RBI messaging over the last few years that keep hedging your foreign currency exposures, penalizing banks if you have a borrower who's got unhedged foreign currency exposures, that appears to have worked. Okay. So clearly, currency depreciation is going to make people who are in the business of largely importing goods and selling here, at the margin they will come down or their prices will go up, and then demand and supply factors will come in. But otherwise, I actually think some of the noise around the currency depreciation, I think, is a little over the top. And therefore, to use the word which I've already used, I'm a little bit sanguine about the rupee movement as well.
I'm going to ask you on the rupee. I agree with you on growth and on inflation. I think you highlighted that. But on the currency, 14% depreciation when your inflation numbers are quite strong. I know we had appreciated, on a real effective exchange rate basis. But still, I mean, that's got to have an impact on the fundamentals, right? Whether it's on inflation or it's on reduction in growth via the imported channels, which potentially could have come through in yesterday's trade data.
Yeah, so I think, like in a lot of things in life, it's all about the base. It depends on which point you choose. So if I were to take you back to 2013 and take you back to something like August or September, so which is roughly 5 years away, 5 years back, we were at 68 that time. In that case, it's 68 to wherever we are today, 72, 73 half, 1.5%, 2% per annum. So it'll look, we haven't depreciated enough, right? If I take it to the start of 2013 when it was 50, then it will look like 50% since that time, and therefore it will be 10% per annum. So it's a question of where you take as a starting point. You have to take into account the fact that from 2014 to 2017, the currency largely was quite stable. Yeah. And I think despite RBI's almost attempts to shore up as many dollars as they could, but they couldn't buy anything more. So I think taking that into account, the fact that, which base you choose, taking into account the fact that you didn't really depreciate as you would because of your interest rate differential or because of your productivity differential and so on and so forth, inflation differential. I think it's 14%. On the one hand, it looks, wow, but you have to take into account the fact that, you enter 2018, oil prices start shooting up suddenly, oil price shooting up, therefore Indian asset markets don't look so attractive if you're outside India. So therefore, the portfolio flows which were really filling up some of your capital account deficits. So the capital account deficit is widening, and this actually, rather than filling it up, is causing a further gap in the BOP. I don't think it's particularly, but I don't think we should translate currency weakness into either indication of, let's say, macro stability, weak economy, demand destruction, or any of those things, which is where I'm sort of coming from.
Okay. But tell me, you're saying that it's different from 2013 in the sense of, what you pick up from the market. Can you explain that? What is different between now and the 2013 depreciation?
Yeah, so I think in 2013, the main thing that we noticed was that initially, I think there was a sense, I think the number one difference was this was about, that 2013 was about 4 or 5 countries. Yeah. The fragile 5. Now, we could argue whether we were fragile 5 or not, but in 2013, your current account was worse than where we are today. Your reserves were $125 billion, were less than where they are today. Your inflation was 300 to 400 basis points higher than where it is today. And you had a sense that there was a political, elections were around the corner, etc. So, it was like the perfect storm which hit. And so that's at the macro level. At the micro level, what we noticed was that point of time, I think a lot of companies the same thing which has caused a lot of the problems in banks, lending to sectors because the growth was assumed, demand would come through. I think a little bit of that was also playing in the minds of borrowers as well, that, it's our generation, it's our time now. You borrow in dollars, you convert dollars into INR, the lending rates there were 3% or 3.5%. The country is going to go places in the next 25 years, so therefore your currency is going to go places in the next 25 years, and then it suddenly went bad. Okay. So therefore you had effectively what I would call stop-loss hedging, or stop-loss buying of dollars. Yeah. I think both things are different now, is I would say. I think the number one thing, and I would agree with people who keep highlighting this, that your growth is steady, your fiscal deficit, to give the credit to the government, the one statement that they keep reiterating, that we will not breach 3.3, is the only thing they can do, because the government doesn't really import directly much. So it's got to control the fiscal. The current account is through the consumer channel. Inflation stable, fiscal deficit stable, a central bank which has been, I think, using up reserves sensibly. I think you have to understand in 2014 to 2016, when when dollars were coming in, what was that surplus? That surplus was portfolio flows.
Yeah.
Because it's portfolio flows, the nature of the inflow merits the nature of the intervention. It is only right that because you know these are reversible, you soak all of those up.
Yeah.
Correct? So therefore, the entire 150 odd billion dollars, that's why your reserves went from wherever they were to 425. This time around, what is the shortage? The deficit in dollars is more the current account related. So it's permanent. Okay. So it's people who say, oh, when they bought so aggressively, but when they're selling, they're not selling as aggressively, i.e., they should draw a line in the sand when it comes to the rupee. I would highlight this difference to them, that the nature of the dollar surplus was portfolio. The nature of the dollar deficit is more excess of imports over exports. And therefore, it would not be right to bridge that whole gap.
Okay, so in that sense, even something short-term like the FCNR, etc., would then not help, right? I mean, if the nature...
Yeah. Maybe I'll just come to that question. Just again, the difference between 2013 and now, and I think it's quite relevant. In 2013, oil also was showing similar characteristics, right? It was 80, 90, 100. But the difference between 2013 and now, when last time around, all of us as consumers were shielded from the oil effect at whatever, at $50 or $60 a barrel, we were shielded, okay? The entire pain was taken by the weakest link in the economy, which is the fisc.
Yeah.
So the fisc bloated its fiscal deficit, which made the central bank worried because these were excess borrowings only funding subsidies. They were inflationary in nature. That makes, that makes external observers also worried. So that's just on, because oil has caused a lot of the challenges. But in 2018, what is happening? Pain of oil is being distributed to the strongest part of the economy, which is the consumer. So 130 crore people are paying whatever, 1 rupee, 2 rupee, 5 rupee, 10 rupee, depending on what we consume every day, 100 rupees, let's say, depending on our ability to soak up. So it's very, very different. This pain is now going directly into the consumers. So we are experiencing the same pain of oil that an American consumer feels or a European consumer feels, and therefore its macro implications are only on the exchange rate and not on the fiscal and not on the inflation, I think, because the oil part of it is just somewhere else, I guess.
Sure, okay, got that. But so then you think that the response to the currency has been more or less appropriate, some tinkering on the import duty side maybe, not very large. So they're letting the exchange rate take the bulk of the adjustment and pass that on to demand. The central bank is only intervening to reserves, no interest rate intervention, which a lot of people had expected this time round.
Yeah, so I think you fundamentally have to come to a conclusion whether the mix of current account widening from 1.5% of GDP to, in a very short time frame, to whatever it will be, 2.7, 2.8 or up to 3% of GDP, whether portfolio flows reversing, not just not coming in size that you need, but actually getting withdrawal, this combination merits a currency weakness or not. I think that position you need to take. If you come to the conclusion, no, this doesn't merit a currency correction, then the question is, how much should we intervene? How much duty increases should we do? But if you come to the conclusion that the currency correction will be part of the solution, and if we don't do so now, you are just having a pressure cooker which will build up, and then one day you will have the consequences of that. So I think allowing currency to go by and large in line with flows is the right approach. Very clearly, because the central bank had bought $150 billion, it can't just say, I will not provide anything back, even though the nature of the deficit which I described is different. So I think by and large, making sure that you are in line with the broader dollar index, incorporating the fact that your problems are more acute and therefore you might overshoot the index at a point of time is the right approach according to me.
So you don't see the need for any one-off schemes, etc., NRI bonds, FCNR?
So I think interest rate, you spoke about interest rate as well. So, the RBI has a legislative mandate now. Okay.
Which they have.
So it's you can argue, but they can't read it in such a pure form or whatever. And I even grant that argument, but I am still not entirely convinced that raising interest rates is either going to deter the outflow of dollars, which assumes that you and me borrow in our local currency, and we find the local borrowing rate so low that we want to take the dollars out and invest it somewhere. And at the end of 1 year or so, despite the lower interest rates, we will have made up in the capital gain of the currency. So I don't think realistically much of that happens in India.
Okay.
So the other is a lot of people are borrowing abroad outside India and are transferring the money here. And I think then presumes that they only have India and US to look at and nowhere else in the world. There are other countries, the dollar index is there. I think it would be quite simplistic to assume that you raise interest rate by 25 or 50 basis points and people will ignore that oil is at $82 a barrel.
Sure.
Okay, so I think taking into account all factors, I think it's better to be really aware that this could be you're in for a long haul and you shouldn't use up either significant amount of your reserves or significant schemes, if I can call the FCNR scheme that, unless you've come to a point where you think, now the market is getting ahead of itself. And I don't think so. I don't think there is a real need to panic. And the biggest worry would be if somebody panics when there is no need to panic.
Okay. Let me switch focus to the other problem we have, purely domestic, which has emerged in the debt markets out of nowhere. But again, cannot be ignored because it can have systemic implications.
Yeah.
What do you make of, first, the concerns around liquidity, which the RBI addressed quite quickly, and then the concern that the liquidity is not enough because trust issues are impeding flows?
Yeah, so I think you're right. I think it's sort of, obviously we have the public issue around ILFS, so that's very much there. And then for reasons which we'll only know with the significant benefit of hindsight, you had some doubts in the minds of certain companies about the ability of certain companies to refinance themselves in the CP market. As I've understood, it really began with certain large investors in short-term fixed income schemes, liquid funds, etc., sort of suddenly becoming a little cautious and therefore opting to exit those schemes that had exposure to names or sectors where they were uncomfortable. Now that's all fine if everybody withdraws and everybody's told that if you have these names or these sectors, we will not remain invested with you. There is no third investor outside of this. So I think from a central bank perspective, they can say we are watching the market, which is what they have said. They can assure enough liquidity to the wider system, which is what they appear to be doing. I think the good part is not only are they giving like the dip into SLR for your NCR or the OMOs, they've also linked these to the state of the financial market so that everyone knows this is to address this and not to address currency in circulation or things of that nature. Okay. But I think the challenge will be if you find there is so much risk aversion that people would rather use that liquidity and give it back to the RBI at the reverse repo counter.
Which was happening, right, in the last few weeks?
Yeah. So I think what you need to, what everybody needs to continue to watch even today is, does that money go to companies that are not able to refinance themselves in the capital markets, and where the bank lines, let's say, are not available or not being made available. So I think for the NBFC sector, there's a bit of a nervous calm in the market. But each day is better than the previous days. That's how I would put it. I think it's important, let's say, next 30, 40 days for everybody, the companies concerned, to make sure they are doing the right things. They can't just say, RBI will sort it out, or banks will sort it out, or mutual funds will sort it. It's their, the number one problem, is theirs. So whatever they need to do in terms of liquidating their assets, tapping bank lines, moderating the rates of growth if need be, and therefore disbursing less than what they're receiving, all those things. So I think that part has to be done by them. And from at a wider regulatory level, I think you just need to make sure you be prepared for a contingency plan. Because there is no lender of last resort to NBFCs.
To NBFCs, absolutely.
So can we have a lender of last resort plan ready? I mean, that's really the question. At this juncture, is it needed? I don't think so. Okay. But I would keep the plan ready in my pocket.
Okay. The CP market had picked up significantly over the last couple of years. At that point, it was thought to be a good, development. Now, I think since September, there's been concern about, volumes coming down. Volumes have come down. I don't know if it's temporary or not. Rollovers not happening because corporate treasuries, apart from mutual funds, corporate treasuries, HNIs don't want to get into this market. Yeah. Is that realistic, that concern?
No, see, I think you will always have these periods of greed and fear and the balance of that. So when everybody wants the extra 30 basis points, if you ask a lot of fund managers, money by thousands of crores used to move because in the previous week some fund manager or some liquid scheme has given 10 basis points more. So that is the greed phase. For 10 basis points more, you are going here and there. And right now you're in the fear phase where you're saying, listen, I'll take 100 basis points lower, but I don't want to go back to you. So I mean, these phases are never permanent. I think if things stabilize, then money will flow back. Liquid funds have a unique characteristic that while the size is huge, the number of participants is not many. You would have maybe 500 to 1,000 companies that account for, companies and institutions that account for an overwhelming majority of the funds there. And therefore, it's a relatively small population. It's an informed population. So I think we should prepare that it will take them prepare their boards, etc., to give them more time for them to go back. So I think if I was the company there, I would say provide for the rest of this FI to have less dependency on the CP market and the bond market, at least through the mutual fund route, and to have more dependency either on direct borrowings through public bonds, and we've seen some companies opt to do so, develop alternate channels like retail deposits or whatever, or work more closely with banks. I mean, the reality is banks have been used as standbys without really any reward for providing those standby lines. Hopefully, as a banker, I think we will also get the benefit of providing those.
Don't look so despondent. I'm sure you will get your due. Last couple of questions, this is the way. On foreign investors, you speak to a lot of people. I think the foreign FPI numbers are very, discouraging, right? 90,000 crore last, and equity outflows have also picked up. Debt has been negative. Is this an India issue? Is this an India plus EM issue? Is this a US rates issue? What's your outlook?
Well, the answer is all three.
All three.
Okay. We have to go really a long back in time to figure out when the US was raising interest rates, and this time around it's not just raising interest rates, but it's also withdrawing liquidity. Yeah. And therefore, because that period really goes back like 2004, 5, 6, that kind of a period, and you'll follow that template that when they raise, everybody everywhere, there was withdrawal, so everybody will do so. The size of the markets in the meanwhile have become huge, much, much bigger. Dovetail the rise in US rates, the QE withdrawal with oil going higher. If you're sitting in San Francisco or LA or New York or London or Singapore or Hong Kong, give these two combination and then say, okay, which country do you think you want to withdraw a little bit of your money from? I think it's quite okay to expect India will be relatively high on that list for most people. Then the currency effect comes in. You can see oil higher, current account higher. You do realize that your money might diminish in dollar value terms, and therefore you take that money off. So yes, I think we should do everything possible to highlight as a country that we are growing quite okay. Our inflation is low. We have political stability. But you have to also understand one thing, that we are one of the more deeper emerging markets. Okay, to withdraw $10 billion from India is relatively okay. In many other markets, you won't be able to do so itself. So because you have relatively more deep markets, well-regulated markets, where foreign exchange also, there are countries where even foreign exchange you can't take out so freely. Okay, and here we have a principle, as I have understood it, of largely determining who will come inside. But once you give him the ticket to come inside, the outside you don't check why you're leaving.
Unless this new voluntary retention scheme comes in.
That's also then a known thing. You've signed up for it, right? So I think it's from a capital market perspective, I think 2-3 things I would say. I think we have to learn from what the mutual fund industry has done. This whole campaign of SIPs and education and making people believe that this is not it's not an IPO which will double next day or the next month or whatever. That, I can, you have spent so much of the time saying currency is weak, this. Can you imagine if index was 30% lower? Nothing would have changed, but we would both believe it's a crisis. Okay, because...
You're saying better marketing?
No, because you have created a domestic investor base to soak the $10 billion outflow.
Oh, so you're saying widen the domestic investor
So I think the lesson and the message here is, you open as much as you want, but make sure that when they exit, there is enough absorptive capacity. So in equity market right now, you have enough absorptive capacity. In fixed income market also you have for the most part, because foreign ownership is quite small. But since there is always going to be a clamor to increase that whatever the percentage is, I think by all means do so, but make sure that if 30% of that were to exit in a span of 6 months, do you have enough absorptive capacity and open at that rate? I'm saying 30, could be 25, could be 40. That's a different point. But I think that's where I would say that you can't do much about the fact that if people think oil high is bad for India, I don't think it's very futile to argue against that. Yep. You can keep highlighting this, and oil bad was very bad in 2013, which is what I'm telling you. It's now bad, but it's not so bad, because the fisc doesn't take the pain, inflation doesn't take the pain, or through the borrowings channel or whatever. But I think you have to provide for the fact that they are professional investors. They have to take their money off the table where they believe the future is not as bright as some other market.
So good macros. on the growth, inflation, and fisc side. Some management to be done on the markets and on the current account deficit. Broadly sums your views?
Yeah, well, I don't believe current account deficit can be managed. We can't. If we could, we would have already exported more. If we could, we already have imported less.
Just by letting the currency take the adjustment and then demand adjust.
So that's, but you have to do it in a way where the expectations don't become unanchored.
Sure.
Let's say if the belief is that it requires significantly more, you can't, because then that's the balancing task of making sure that in currency expectations can never be allowed to become unanchored, and in our case they don't merit to be also. If you're fast growing and your inflation is low, eventually capital will come back.
Sure. And
you have to just make sure that till it comes back, there is stability.
I'll leave it at that, Mr. Dave. Thank you so much for joining us and speaking about both the macros and the markets. Thanks for watching Bloomberg Quint.